to the AJ Brown Show, where we talk about all things investing, options trading, and the like. Now here's your host, AJ, whose primary mission in life is to help you become a better investor.
All right, ladies and gentlemen, welcome back to another episode of the AJ Brown Show. My name is Cyprian Francis, and with me, as always, the main man of the hour, AJ Brown. Good morning. Happy Good Friday to you, my friend.
That's right. It is Good Friday. The markets are closed, but we still got plenty to talk about.
Yeah, and I don't even know where you would like to begin with that. I feel like the big news this week continues to be Elon Musk now trying to buy all of Twitter. What do you think about that?
Oh my goodness, boy, has that escalated. So I guess last week we talked about him buying just under 10% of Twitter. Then next thing you know, he's tweeting about suggestions. Then I think they tried to corner him, get him to be on the board, but sign some sort of document that said I'm not going to be messing with things, because when you're on a board of a company, you've got a fiduciary responsibility to not mess with the company. And I think that over the weekend, maybe he thought that through a little bit, and then he's like, I don't want to be limited. So he said, no, I don't want to be on the board. And then more comments started coming, more votes. I mean, he's got what, like 80 million Twitter followers or something?
Yeah, and like we talked about, he might actually be able to fix it to be a much better, more profitable company, having the technology background. So it's gonna be interesting. It's like,
I mean, I don't know if you guys remember, but with Tesla, he was not the original owner. He's not the founder of Tesla. And he did the same thing. He was kind of bummed about how slow they were progressing, and he did a hostile takeover. And it wasn't actually very nice. I mean, the folks that started Tesla were quite rubbed the wrong way. This was like, what, 15 something years ago. And he came in and just bought all the shares, took over the company, and then, that had a happy ending. But we'll see what happens with Twitter.
yeah. And then, I feel like the continued talk is inflation. We had some more high inflation numbers this week, and continues to churn that concept of, hey man, we're gonna have to do something about this at some point.
Let's take a look at the economic calendar, because we sure did have quite a few reports come out. On Tuesday, all important consumer price index report. And then on Wednesday, we had what's called the producers price index report. So the consumer price index report measures basically inflation for consumers. This is wholesale inflation. This is inflation that is passed from the manufacturer or from the miner, if it's a commodity, to the middleman. So that's an interesting number to look at. Then on Thursday, we had retail sales, and that sort of tells you how good our sales on the front end. And then on Friday, we also had industrial production. And these four reports come out about the same time every month, along about a week-long period. Sometimes they start at the end of the week and extend into the next week, but it's about over a 5-day period. And it gives you kind of the whole picture. Like, retail sales is what's the interest in buying stuff at the store. Consumer price index is about, how much it cost. Producers price index is how much did it cost them to give it to you, and industrial production is how much did they cost to make them. And so I actually pulled these reports up. The first one was the consumer price, and this one was the one that was all over the news. So you can see here, consumer price index was 1.2%. They expected 1.1%. That's high for month, and 8.5% upgrade for the whole year. I mean, the U.S. looks along really well between 2 and 3%. At 8.5%, that's some extreme inflation. When you factor out food and energy, which is a little bit volatile, especially with oil and wheat and things like that being disrupted with the whole Ukraine conflict. it's still up 6.5%. And so that's quite aggressive. But then when you take a look at the producers price index, I mean, year over year, they're up 11.2%. Factor out food and energy, 9.2%. So, man, that is some inflation that we can expect to still come our way if that's the inflation that's happening at the producers level. But then you look over here at retail sales, and retail sales seems to have dipped quite significantly. I mean, retail sales month on month has only increased about 0.5%. I mean, I guess that's considered high. And if you factor out vehicles and gasoline, so vehicles, when you factor out vehicles, which typically is another volatile, it actually increased 1.1%, which tells you that, a couple months ago, people were all about new cars and all about used cars. It seems like the run on cars has slowed down. But then you factor out gasoline, and it looks like the gasoline prices are really what has been driving retail sales. So when you factor out gasoline and car sales, people are not going to the store as much buying stuff, which makes sense because they're reacting to inflation. And finally, the cost to produce things. Gosh, this goes back to the whole supply chain kind of buildup. They're producing at some really high rates, trying to catch up. So the combination of the supply increasing and the demand, the retail sales decreasing, I think that, we're starting to see the signs of what it would take to make inflation calm down. But the inflation that's in the middle, both in the wholesale and in the retail sale side, is still very, very high.
Yeah, and so now I'm curious what your take on the market reaction to it, right? Where we're at in this, I believe, downturn, right? We when
Mm.
we look at the S&P, right? We do some pretty we've been yeah, there we go. That's kind of what I was getting to, is we're still kind of in this middle section waiting to push back up, or we're going to fall back to these lower levels that we saw a few weeks ago.
Well, I will tell you that so this first move that we saw here was the beginning of an uptrend. And it wasn't the greatest start of an uptrend. If it would have gone just a couple $100 more, we would have considered it a really great start to an uptrend. And when I say a great start to an uptrend, what I mean is that it's fragile and it could easily turn back into a downtrend. So what we're really, really paying attention to right now is how good is this pullback? And yes, pullbacks are necessary parts of moving up. If you don't have a pullback, then your move up runs out of gas at some point. And so you'd rather have these very elegant, controlled pullbacks. And I've been watching this pullback, and I would really love to have this pullback stop in this zone where it is now. And it's actually been stalling in this zone. And if it stops here and starts to head back up, that would be a really positive move for the current uptrend. If it keeps going and it keeps going down, that wouldn't be so positive. That would make this uptrend be even more weaker or more fragile than it currently is. And if it goes down below 4,170, then I'm going to say that this attempt at the uptrend is over. But so far, it has stalled for this whole week in this zone where I want it to. So I'm waiting for a confirmation from a lagging indicator to tell me that this is where it's at. And so I'm watching just a simple 3 and 5 day exponential moving average. And if I get a crossing of the 3 and 5 day exponential moving average and price starts moving up, I'm going to be very content to say, hey, I think that we've got the underpinnings of a really strong uptrend. So then I'm just on to watching that next move. And that next move will just seal the deal. So I bet within about 30 days, 1 month from now, the May 15, I bet that we will know very clearly whether we're going up or down. I actually think that the steps that the Fed has taken up to this point have been just spot on. And I see, I know that the talking heads are saying we're going to see inflation all the way through to 2023, but I actually think that they're doing what's necessary, that inflation will be calm by fall, by end of summer or fall. Mark my words, Sip.
Yeah, we'll definitely take a mark and check back in. And like you said, that 30-day window, we do have the next Fed decision, I believe, is on May 4th. So that is a quality catalyst to move outside of those two ranges that you highlighted. So I think that's what a lot of money managers, investors are just looking forward to, because that can be a surprise, right? Like
Well, and
there's
we've looked, how there's all this, of course, forecasting, right? Which basically means betting as to whether the Fed is going to do a half point rate hike or a quarter point rate hike. And the people who are betting on a half point rate hike, it has gone higher, right? And I think that if the Fed comes back and says, no, I think we're going to just do a quarter point this round, I think that would be a real, because Wall Street is starting to bake in a half point. And if it turns out to just be a quarter point, that, like you said, could be the catalyst to get that third move up, the one that I'm looking for. And I think that would solidify a real nice uptrend. In fact, I think that's how the Fed can kind of orchestrate a soft landing. They're setting expectations low, and then they're going to do something positive. And so I think that that's kind of the balancing act that they're playing. They're playing with our minds a little bit, but that's okay. They're getting us ready for something more aggressive than what I think they're going to do. But you know, my opinions. My grandmother used to say opinions are like buttholes. Everybody has them, and they all stink. So my opinion's as good as anybody, but we'll see who wins up. If it was a gentleman's bet, I'd take it.
Yeah, and I'm curious, like, when was the last half point cut or raise that we've had? Like that's definitely more than what we've done over the past, I don't know, few years,
Mm-hmm. Oh, I'd have to look back, but I think it's been over a decade since we've had a half point rate hike. Yeah,
or even cut, right? So that's
yeah.
definitely something that would move the market and provide insight. All right, so moving forward, we're gonna go ahead and give the audience a chance to throw some questions into the chat. This next little section, AJ is going to run through some analysis of some of the questions that we've got throughout the week. But before we get into that, we want to invite everyone to the daily workshop, the Trading Trader Daily Workshop, where AJ breaks down these strategies and more. Go ahead and click the link in the chat. It'll take you there. And we're going to run our little promo video here and then run into some questions. So anybody watching, if you have any questions about specific tickers, go ahead and throw them in there, and we'll see if we have some time to do some analysis.
I get it. You're afraid of trading in the markets. Guess what? I've got your answer. I've got 4 strategies I'm going to give you, along with the tools to make it super easy. I'm going right home, giving you the webinar. I need you to sign up below and meet me in a few minutes.
All right. So, AJ, we've had this young investor asking us questions for the past month, and he keeps coming back with good ones. And I feel like this third follow-up deserves a little bit of insight. And his question is, which I think everybody asks this question when they're trading, is how do I make sure I don't lose money?
Yeah, this is Manny, Manny from Akron, Ohio, and he keeps coming back, and I'm pretty stoked about. He's 10 years old, and his question was, "How do I not lose money?" He said, "I have to go to school, you know." And so, Manny, here's what most investors do, traders, I should say. They do one of really 2 things. First of all, they use something called stop loss orders. Now, these are orders that you can place with your broker that get triggered at a certain price, whether it's the price of your asset or now they have more smarter ones where you can actually trigger it off of the other asset, which is good for us option traders. Could we can say, hey, if the stock drops below this certain price, or if the stock goes above this certain price, trigger a sale on the option. Or if you're using the option price, that's easy. Just say, if the option price goes below this certain value, trigger a sale. And then they'll go ahead and bring it to the market and try to sell it. And if you're doing it as what we call a risk stop loss, that means so that just exactly like you described, when you're at school and something bad happens and you need to sell before you lose anything, that risk stop will just be sold at whatever price they can get it at. So that's kind of a neat way to protect your losses. And we can even incorporate things like trailing stops, which adjust and ratchet in only one direction, so that as the stock and as your option goes up in price, so does the stop loss. And then the minute that the stock or the option goes down in price, it gets liquidated and you get to take the cash and profit and put it into your piggy bank. But another way that people protect themselves from risk is they actually will buy some sort of asset that will appreciate at the same rate if there's any sort of loss. So we buy protective options. And so when you buy a protective option, Manny, what happens is when you hit a certain price threshold, we call that the strike price of the option will start increasing in value for every dollar that the original trade goes down in value. So now you actually have two trades that balance each other out equally. And so people employ these protective options all the time as well. There's pros and cons to the stop loss and the protective options, but these are just two methods that people use so that while they're at school or at work, they can do their trading and not have to worry or lose any sort of sleep or any sort of, be stressed out at the school desk thinking about what's happening to their money. They're protected.
Yeah. And as much as we'd like to say that there's a secret to never losing money in investing, that's just not possible, right? You're just trying to limit your risk and you're trying to make more money than you lose, and always, be aware of what you're doing.
So Sip brings up a good point, Manny, and that is, before even all the logistical things of stop loss orders or protective options, you want to plan out your trade. And when you plan out your trade, you want to make sure that the size of your trade is commensurate with the amount of risk you want to take on. So there's a key component of planning. In fact, that's what my whole program is all about, Manny, is I teach folks not just how to trade, but also this whole planning process so that you know exactly how much to trade, how much of your portfolio to trade, the sizing of the trade, and where to place the risks, right? Because sometimes you want to allow the symbol, to move without ending your trade, because you don't want to end your trade prematurely. So there's a whole kind of science to this. But I have to tell you, I've had plenty of folks at the same level as you, 10-year-olds, fourth graders who totally picked up my program. So I'm not asking you to be part of my program, Manny, although I think maybe your parents are part of our program, just guessing. But I'm telling you that it's not above you, even though you're a little guy. So just want to keep that in mind too.
Yeah, so to all the adults out there, if we've got Manny in the classroom understanding these things, then you should be able to hang and partake in some of these strategies.
In fact,
Uh,
Manny, you should check out the free workshop. In fact, this weekend I am scheduled to update the examples with more current examples. Usually we update these every few months. So you should check out our workshop with the updated examples, Manny, and see if that makes sense to you.
Awesome. We got a couple tickers we're gonna crank through. So as we mentioned, if anyone watching in the audience has a specific idea, strategy that they want us to go over, drop it in the chat. Let's go over your first pick of the week. And we were just talking about this earlier, and that's Charles Schwab, which is we both bank with them, and
Yeah.
they have wonderful service. So I'm curious to see what you're seeing on the option side of things.
Yeah, Charles Schwab is a fantastic. There was a time where there were laws, and this was after the Great Depression, where they totally separated banking from brokerages. And around the late 90s, they went ahead and kind of softened up those laws, and a lot of brokerages became banks, and a lot of banks became brokerages, and they kind of intermingled their business. And I have to say, being a banking customer as well as a brokerage customer of Charles Schwab has been pretty fantastic. Their services, especially around banking. I mean, they have great customer support, and in addition to that, I can go to any ATM anywhere in the world, not just here in the States, and they'll refund all the fees and all the transaction fees in order to use the ATM. So I really like that. Schwab about a year ago purchased TD Ameritrade and Thinkorswim, which is one of the platforms that we use here to analyze options. And so we've been wondering, what is Schwab going to do with all the TD Ameritrade? And so far, Schwab is operating TD Ameritrade as a separate company, but we know at some point they'll probably want to consolidate. Who knows what will happen to Thinkorswim? With that said, yeah, go ahead.
I was going to say, and both TD Ameritrade and Thinkorswim are fabulous products, trading products. So what will happen is should be interesting, because it's a lot of different technologies being combined into one. But I'm wondering what effect that has on the stock price.
Yeah. Well, what I like about Schwab is Schwab, like we said about any premium selling companies that we get into, Schwab is somewhat boring. Now, of course, if something happens with the TD Ameritrade, they'll make some headlines and we'll probably see some price action. But for the most part, Schwab just hangs out by itself around this $80 price tag. Now, $80 is a little bit pricey, but Schwab also has a lot of liquidity in substitute options. So check this out. Back on March 10th, right about here, I was able to buy some Schwab call options. And I bought these call options in a way. I picked the call options that would most mirror the Schwab price action. And so I only paid $34. I paid $34 for these 47 strike price call options that were going to expire not until January of 2023. So I bought these things for $34, and then I waited. And once this thing started to peak and started to come back down, that's when I went ahead and bought a protective option down here. I actually bought it all the way down here at $75 because I was looking at this previous price action. I'm like, I don't want to start kicking in protection until it's necessary. So I bought a $75 protective option. This was a protective put. The expiration on this thing was June. And in order to, by the way, I spent $1.40 a share. So let's write all this down. In order to buy the substitute option, I only spent $34 a share. Then I bought these protective options for $1.40 as soon as the underlying symbol, as soon as Schwab started to march against me. I wanted to protect myself. So, Manny, this was a perfect time for me to buy those options to protect myself. And before that, I was just using the stop loss order. But as soon as it started to not go in the direction, right, I wanted it to go up. And as soon as it started to go down, I bought that protective option because that protective option, a couple of reasons, but the main reason is because it's going to work no matter what. The stop loss order, there's a little bit of fluff in there, and we talk about that a lot in my program. Now, in order to offset this $1.40 cost, I sold some premium. In fact, I sold the $90 strike price, expiring right here yesterday, April 14. So the $90 strike price call, I sold that and I made $2.20 per share. So on the same day when this thing started to pull against me, I bought the $1.40 protective option and I sold the 220 premium option. So if you think about that, I actually walked away after paying $34 a share. I actually walked away with my protection in place with an additional 80 cents per share. But that doesn't stop right there. As soon as I started to bottom out here, and I think it was about 2 days ago, as soon as I bottomed out there and I started to head back up, I sold my options back. So these things that I bought for $1.40, that after I offset their cost with the 220, I actually got them for free and got an additional 80 cents a share to boot. I then was able to sell these things back for $2.50. So check that out. I bought them for $1.40. I sold them back for $2.50, and I got to keep that $2.20. So I paid $34 for these things. Let's actually pull up the calculator here. If I pull up my calculator and you talk about the most I was into this trade was for $34. So $34 was my initial investment. And then if you think about it, I made $2.20. I spent $1.40, and then I made another $2.50. That premium option expired worthless yesterday. And so I'm up to $37.30. That's $3.30 per share profit, which is almost 10%. I've already made 10%, and guess what? I'm still in Schwab. I still own the stock, and I'm up 10%. And all I did was a couple of trades on March 10th, and then another trade on I'm not March 10th, a couple of trades on March 30th, and one trade on April 8th. So in this whole position, it went up 10%, and I'm like, that's awesome. And the reason why I'm even telling you guys about this, not that it wasn't like the most easiest trade to do, because it really was, but also because now's an opportunity to get into this symbol again. This is a fantastic opportunity. We just got confirmation that we had a bottom. This is a great time to be buying some of Schwab, or if Schwab is too expensive, to buy some of the Schwab back month options like I did. Some January 23, 47 or $50 calls would be just what the doctor ordered. They're quite inexpensive compared to the price of Schwab itself. And you'd be able to do the same thing. As Schwab goes up, your main position goes up in value. And if Schwab pulls back, do the same thing I did. Buy a protective option to protect yourself and offset its cost with a premium sale, and then let the premium sale expire worthless, roll out the protective option, rinse and repeat, 10% guaranteed every month. Not guaranteed, but 10% possible every month.
Yeah, and I think for any of the new viewers, that is, an approach you seem to do often is these three types of ways to make money off one move, and then finding these little reversals and just keeping it going. So I think this is a prime example of how this works week in, week out across the board. So let's go ahead and keep on doing some more analysis. We do appreciate anybody who asks any questions. Feel free to drop them in the chat. Moving on, I believe the name I got here is Vinay. I'm not sure if I spelled that right, but Vinay from Phoenix is asking about ON Semiconductors, which I feel is like a hot topic these days with all the supply crunches.
Yeah, ON Semiconductor has been they're actually based in Phoenix. So I wonder if Vinay has some sort of affiliation with ON Semiconductor. The scoop is ON Semiconductor is big player in the semiconductor world. Phoenix is actually a city that was built out, big time on semiconductor manufacturing. And I know that a lot of the, there was a lot of push over the last like 5 or 6 years to bring semiconductor manufacturing back to the States. And so I believe that Phoenix is firing up again big time. With that said, looking at the chart, here's what I look for. I look to see what kind of channel are we in. And it actually looks like we're in some sort of sideways channel. If I take a look carefully, it looks like we have some tested resistance up here around C750, some tested support around maybe 5250. And one of the things I like to do is I like to create a little, whenever I identify these channels, I like to take my calculator and my calculator, and I like to take the width of the channel. So in this case, the width of my channel is whatever, $67.50 minus 52.50. So it's a $15 wide channel. And I'm going to take the halfway mark. In this case, it's $60. So 15 divided by 60. That means that the width of the channel is 25% of the price of the channel. And that's a good width to price ratio. If it's too small, that makes it difficult to do this premium selling that we talked about on Schwab. So, Vinay, I think that this company is perfectly positioned to make some money for us with premium selling. And in addition to that, it's not quite there. Looks like ON Semiconductor is about to tell us that it's done going down. That's a nice big fat drawing mark. It's going down. Let's see if I can do that one more time. There we go. Let's see if we're going to do that one more time. There. You're killing me. There we go. It's done going down. It's about to tell us that it's done going down, and that would be a perfect opportunity for us to either buy some of this stock, or let's check out, because I know about this company. I traded it maybe about 10 years ago, but I haven't traded it recently. Let's take options as substitutes. I generally like to go pretty far out in time, like at least 8 months. So I'm interested in this January 2023. They call this a leap option. I go pretty deep in the money, and I want to see if there's any sort of liquidity. And I see some open interest, and I see pretty healthy bid-ask spreads. They're not too big, not too small. So I'm actually, and somebody just, some whale just went ahead and did a huge purchase of this $45 call. I can see the order coming through here. You can't hide that stuff. But with that said, I think that there's some liquidity here. So that's what I would be interested in doing, finding a substitute option. The substitute options are going for maybe half the price. Oh, wait, I'm looking at Schwab. I apologize. Let's look at ON. Here we go. Yeah, I still stand by what I said. There's open interest. There's healthy bid-ask spread. $53 is the price of the stock. About half the price. So if if the price of the stock is a little high for you, we can use a substitute option. Find an option trading at parity that's about 8 or more months out. And I think you'd be set well to both appreciate on that stock or substitute option, but also if it starts to pull back like it has over the last couple of months, doing that premium trade and that protective option rollout that I keep talking about every week.
Awesome. Great insight. Thank you very much, Vinay, for the question. Moving on to our next one. Not sure we caught the name, but the ticker that we're trying to look into is JOE, St. Joe's. I'm not even sure I'm familiar with the company.
Oh, I've traded this quite a while. This is a real estate play. It's a company in Florida that has a couple of different arms, both residential commercial, and they also get into the management of properties as well as kind of the building and the renovating of properties. So they're all over South Florida. It's called St. Joe. So look, um, St. Joe was going sideways. It was a great premium trade. And since then, it has turned into a trending trade. Now, let's hear what we have been talking about with the S&P 500. So the S&P 500 did a move up. It pulled back, and we're waiting to see where it pulls back to. Notice that St. Joe went on and it pulled back to a really nice place, and then it went up again, and now it's pulled back. You only need 3 of these moves. So here's the first move. Here's the second move. And the third move. It takes 3 moves to make a mature channeling trend, something that people start to subscribe to. You'll notice with these 3 moves, we now have 2 tests of support and 2 tests of resistance. That's all you need to define a channel. So that's why we're thinking so hard on the S&P 500, looking for that second and third move, especially where they are, because that's going to define everything moving forward. Coming back to St. Joe, let's kind of run some scenarios just very, very quickly. If you were, busily thinking about the thing as a premium trade where you had your defined level of resistance, you had your defined level of support, and this February went by, your premium expired worthless, you started to see the stock go up, and so you rolled out your protective option. The next thing you'd be doing is you'd be looking for the next opportunity to sell premium. Now, usually, if the underlying symbol pops out of the channel a little bit like St. Joe does, we don't worry about taking our profit off the table. Instead, we go ahead and sell the premium, buy the protective option. And then over here, we would sell back the protective option. And you'll notice this is the day that the premium expired worthless. So I'm sure if you were selling premium on this, that you were able to pull out yet another gain. The question then is what do we do here? At this point, I would probably say to you that this has turned from a premium trade into a trending trade. And at this point, I'd sell whether you bought the stock or you'd sell the back month option. I'd sell them instead of trying to continue to sell premium and buy protection. At this point, I'd say take the profit. So sell, and take your profit and run. As far as buying into St. Joe, it's not really a premium trade anymore, but it's turned into a trend following trade. And so I'd actually look at this a little bit differently. Instead of, I think I'd look at this as a swing trade. And I think I just missed the opportunity to catch the most recent swing, but I'd basically be using some sort of leading indicator. One of my favorite is the Williams percent R. Larry Williams is just the bomb. And he came up with the Williams percent R. And I would look for that to go to an extremely oversold condition. But I wouldn't use that as my entry signal. Instead, I would wait. Once I saw that we went to an extremely oversold condition, I'd wait for some sort of lagging indicator like the fast MACD or even just a close above the 7-day simple moving average to give me a signal that we're going to swing back up the way that we swung up here, the way that we swung up here. I don't know if swung is the correct way to say that word, but and so I would trade this as a swing trade moving forward. But what I like is we were able to easily transition from a premium trade into a directional trade. So St. Joe is one that I think you could easily use a couple of different trading strategies: premium selling, directional swing trading, even trend following trading, and like really elegantly go between them without like losing a lot of sleep.
Yeah, I have a follow-up question to this. Seeing as they are in the real estate space, do the potential rate hikes have some sort of historical implications on the real estate industry?
Hmm. Yeah, rate hikes, what do? They really slow down investment into real estate. One, because the users now have a harder time to get mortgages, affordable mortgages. There's a lot more interest rate on the mortgages. That's one of the things that raising the interest rate affects almost immediately. I mean, already, like people with adjustable rate mortgages are seeing their rates go up. So the demand for real estate products goes down significantly if the Fed keeps raising interest rates. So that's the first thing. But the second thing is the investors who invest in companies like St. Joe or who invest in real estate. They're not going to be as eager to invest in real estate because they can actually, because real estate sometimes is seen as like a more, you get into a piece of real estate and you don't expect your return on investment for years. And I think they're gonna probably take their money and say, "I bet you now that the interest rate on bonds is going up. I can probably make as much money that I haven't been able to make in bonds, and move my assets over to bonds." So I think you're gonna get a double whammy on, real estate stocks. I think you're gonna see, number 1, that just the demand for their product as a company is going to go down, and number 2, I think that we're gonna see, investors who invest in real estate start to disappear. So, again, I hope that the Fed doesn't overcorrect for inflation by making interest rates go up too high and stopping their quantitative easing and actually reversing their quantitative easing too quickly, because that could, really cause people to leave the real estate and that would pop that bubble. I think they want to make a slow deflate, right? But yeah, we better watch that. We better keep our eyes and ears on the tide of what's happening in the real estate sector. So keep your eyes, folks, not only on like the S&P 500, Dow Jones Industrial Average, and the Nasdaq, but if you've got particular symbols in your watch list, be aware of what sector they're in. And many times the sectors, whether you're looking at it with an ETF or with an index, you can get an idea how the sector is doing. So add that to your kind of starting analysis every evening. What are my sectors as well as my indices doing, so that you can get an idea of what the tide is doing, so that your individual investments, if they're being pushed up by the tide or if they're like being pulled down by the tide. That's going to be something to keep your eye on.
Totally. Appreciate all the questions from everyone. Feel free to drop comments after the live stream. We do go back and check some of those, and maybe we'll bring it up on the next episode. Going into the weekend, AJ, on a no market Friday, any advice, any wise words?
Yeah. Take it easy. Enjoy the 3-day weekend. Don't obsess about your portfolio. Maybe check out for a moment. And yeah, I think that you should take a well deserved moment away from the markets. That's my 2 cents.
Yeah, and I don't foresee too much happening this weekend to change where we're at otherwise, but you never know these days. The world is a fast moving place, and
Yeah.
we do still have a war going on, so who knows?
Do you have the heat wave still going on in the West Coast?
No, we're actually back to, boring 70s.
Ah, cool. Because you guys were up in the mid 90s.
Yep, we had a couple days and it was fabulous. But we're cooled off for the Easter weekend, so we've got Coachella going on this weekend. I don't know if you're familiar, but it's a big music festival outside of Los Angeles. But what's cool about it is it takes a lot of people out of Los Angeles, so now it's a little calmer this weekend.
Oh, maybe you'll be able to drive around.
right. That not too many crowds at the beach, etc.
Yeah.
Hiking trails, things like that.
Yeah, I think so. I think that here, so we had a little, we didn't have mid 90s, but we had mid 80s, which in April is unheard of. So, but it cooled down as well. I think we're early 70s. I think my wife and I are going to head down to the Smithsonian. There's a special museum exhibit, some artist. So we're going to check that out. But I think that we're going to head down to our beach home. So I think next week when we have our show, you guys will see a different backdrop. We'll be down at our beach house enjoying ourselves.
Awesome. So with that said, we wish everyone a happy Easter, Good Friday, no market weekend, and we'll catch everybody next week.
Take care, everyone.
Thank you for tuning into the AJ Brown Show. If you're interested in learning more about AJ and his investing techniques, head on over to tradingtrainer.com and create your free account today. And if you're not already a subscriber to the show, hit that subscribe button and we'll get you fresh content daily.